But let's talk about the management of a company that joins us now, TVS Supply Chain Solutions, in focus on the back of their fourth quarter numbers. The company's overall revenue grew about 4.5%. However, for the integrated supply business, there was a double-digit revenue growth. We have two Ravis with us, Ravi Prakash, who's a global CFO, along with Ravi Viswanathan, who's the managing director of the company, joining in. Thanks a lot, gentlemen. Both Ravis. We'll address you all as Ravi Prakash and Ravi Viswanathan when we're directing the questions to you. For the year, if we look at it, we've seen a decline in your revenues. 10,000 crores has come down to around 9,200 crores, but we've seen an improvement in the margins. So let's start with the outlook for FY25, as it were, Ravi Viswanathan, that is. If you could give us a sense of what's the growth that you're targeting in both your segments in FY25?
So let me actually qualify that answer first by saying FY24 was a very interesting year from an ISCS perspective. The segment grew double-digit, and it has been a significant growth that we have had over the last 4 quarters on the ISCS side. And looking at FY25, we expect that to continue. We expect to continue double-digit growth on the ISCS segment. If you look at FY24 and look at the network solutions segment, globally, I would say the trade volumes have declined, and that has had an impact on the freight business globally. And this is nothing unique to TVS Supply Chain Solutions. And we've been talking about it over the last few quarters about the suppressed demand, and also the fact that the wars are not helping. The Red Sea situation has also created certain uncertainty. So I would say that when we look forward, we are very bullish about the integrated supply chain solutions. We are focusing really on the profitability of our network solution segment while we continue to look at all of the opportunities for growth. So it's very difficult to put a number on the growth for FY25 for the network solution segment. Our focus really is about to say, how do we make sure that we are growing profitably, ensuring that we are moving all the levers in the network solution segment to deliver profitability while we continue on the integrated supply chain solution side with double-digit growth. Having said that, I would say that we are very confident with our strategy. Our strategy is really about customer acquisition and customer mining. You can see that our Fortune 500 customer has increased from just about 64 2 years ago to 72 last year to 78 in the year that just ended. So it's a significant expansion of our Fortune 500 customer. Our strategy is really about that. Global accounts, look at selling capability to our customers in the global market that we are present, and then deep mining our customers. And all of that is paying rich dividends when it comes to our overall business, and especially in the integrated supply chain solutions.
All right. Good morning, gentlemen, and good to see you, Win. So would it be fair to assume that a double-digit growth is something that you all would aspire to do? That's point number one for the entire business. We're talking about the entire business at large. And also, what was encouraging in the past year was that margins have steadily been improving. Do you think that kind of an improvement could continue, going by some of the factors that you just mentioned in your introductory note?
Absolutely. And I think double-digit growth is the focus of the company. And that's our aspiration. We've always spoken about profitable growth. And regarding margins, I think if you look at it, and I'll ask Ravi Prakash to comment on it, look at it over the last 3 years, our growth in margins have been significant. Even if you take the revenue, our growth on a CAGR basis has been something which is very impressive. So specific question to answer, yes, and I'll probably have Ravi Prakash give you the details on what we are looking at, both from an FY24 and a trend line which you can draw from there over the last 3 years.
Specifically on margins, I think if you look at our numbers, we started, Q1 was tough, but Q2 we had a improving profit before tax. Q3 we broke even. Q4 we've delivered a PBT in the black. Each quarter has improved versus the prior quarter, and that we expect to continue in the next 4 quarters coming. Number one. Number two, we've always said that every year we would try to expand our margins between 50 to 100 basis points, both at an EBITDA as well as an operating income and PBT level. And that medium-term outlook continues, and we expect to deliver that quarter on quarter.
All right, 50 to 100 basis points margin improvement. That implies that by FY26, you would be in the double-digit range when it comes to the EBITDA margins itself. What's interesting is that you guys have also been seeding some new businesses, and that's almost 9 to 10% of your overall revenue mix right now. So Let's ask Ravi Prakash, do you have any incremental target on that one? What is the contribution that you would likely to see from, the new business developments that was just about 10% in FY24 revenues?
So when historically we've done between 10 to 12% of the closing revenue. So we expect to continue that trend. In fact, that is the number one focus of the company. If you look at it, we've been trying to grow organically through new business development. So we don't expect, in fact, if anything, we want to push that even harder. So going forward as well, at a minimum, we would like to do 10% of the year-end target through new business development and push that even more. And that's where, you've got the order pipeline up on your screen. That's what gives us confidence that we will be able to deliver that.
Okay, all right. Let's focus a little bit on the balance sheet. Post your IPO, the interest cost has come down substantially. I think you were guiding for 30-40 crores of interest cost reduction. Could you tell us what is the current debt in the books, and is there scope for further improvement? If yes, quantify it.
So before we went into the IPO, we had a gross debt of almost 1783 crores, and now it is down to 794 gross debt. So a couple of good things. Today, we do not have any long-term debt. So we had signaled in the IPO that we would use the proceeds to pay down all our long-term debt. We've done that. The debt that is on the books today is purely working capital. And in fact, if you take the cash into account, the net debt is just around 200 crores. We don't expect that to move materially over the next 12 months. And that's the reason, if you look at the Q4 interest cost, which is around 17 crores, that's what we are guiding towards for the next 4 quarters. Any increase would only be because if there are any substantial projects coming on board. Otherwise, we are targeting very tight working capital management to get the maximum leverage from the one-time capital structure restructuring we've done.
All right, let's go back to Ravi Viswanathan as well. Ravi, 30% of your revenues come in from India. The world is talking about India, while you are getting 70% of your revenues from the rest of the world. So are you looking to increase that part of your pie? And at the same time, is there any differential in the earnings that you make from business in India and business abroad?
Yeah, I think our focus, of course, is to tap on the opportunities in India. There is tremendous economic activity in India. But I would also say that last year was a bit sluggish when you look at the overall opportunity in the supply chain side. And if you do a comparison with the peers, you'll probably see that most of the peers have been in that narrow growth range. We expect this year, hopefully post-June, to have a normal economic activity or even better, and we hope to tap onto it. The second part of your question, yes, there is, obviously India is really about volumes and trying to grow the business faster in India. So we would be willing to look at a slight dilution in the margin when we compare with the overseas business. In that way, I think the portfolio mix that we have, 70-30, 70% coming from overseas and 30% in India, really helps for us from a ability to invest in businesses in India. See,
do you have an aspirational target of? Yeah, do you have an aspirational target of how much should eventually come from India?
I think over the next couple of years, we would like that mix to go to 35-65 from where it is currently at 30-70. The nature of businesses outside of India are typically large outsourcing deals. We mentioned it about 3 quarters ago when we won a large deal with Centrica in the UK. That is going to open up doors for us for these large transformative supply chain engagements. And today, I can say with confidence that we are very, very well placed in handling those kind of large deals, which otherwise we were not probably being invited 2-3 years ago. Engagement like Centrica have placed us there. And I think the points that Ravi Prakash said, I think we are very fit. We have a fit balance sheet, and it positions us very well to participate in these large deals. And I can tell you that the 4,000 crore pipeline that you saw, we have quite a few which are very large deals that are in the pipeline.
Take that point. Thanks a lot, both the gentlemen, both the Ravis, for stopping by, giving us an outlook on your business, a look back in FY24, but more importantly, look ahead for FY25 as well, with a double-digit revenue growth that you're looking at in your integrated supply chain business, margin improvement of around 50 to 100 basis points, with net debt remaining at that 200 crore mark. And the eventual target is to perhaps increase your revenue coming in from India on account of the large orders that you won. Gentlemen, wish you good luck.